Well, the highest power in all of the land when it comes to Canadian banking, that's OSFI, has made a big change that's forcing Canada's big banks, that's BMO, Scotiabank, CIBC, RBC, National Bank of Canada, and TD, to prepare for a potential worst-case scenario. So we're going to talk about what this change is in a minute, and we'll talk about the reasons that Canada's big bank regulator could be so nervous, and a big problem that was actually just leaked today about one specific bank that could be somewhat of a preview of things to come, and finally we're going to go into how all this could impact you specifically. All right, so let's get into it. Now, the big regulator of the big banks in Canada is OSFI. That's the Office of the Superintendent of Financial Institutions. And their job is pretty simple. Make sure that these big banks aren't acting in any way that could cause the Canadian financial system to be weak or even have any major problems. They're on the lookout to make sure that these banks are behaving as they should. And when it comes to controlling these big banks, one of the biggest tools that they have is called the domestic stability buffer. Essentially, this is a tool that forces big banks to keep a certain amount of cash on hand in case, well, maybe there's some bad debt, people default on mortgages, to make sure that the banks actually have enough tucked away in case of something awful like that happens. Now let me show you a clip that I made from a previous video because I think it's my best explanation of exactly what this domestic stability buffer is, and then we're going to get into all the impacts that it's going to have. Now you might already be familiar with the idea that banks don't actually have to keep on hand all of the money that they're holding for their customers. They can lend out more money than they actually have. This is called fractional reserve banking, but there is a requirement that these banks do hold a certain percentage of the amount of total deposits that they have on their books, and this is called their capital reserve requirements, essentially cash that must be kept on hand, and this is a percentage relative to the amount of money they actually have in the bank. There are a bunch of different things that make up the amount of this capital reserve requirement for each bank, and one of those things that contributes to it is the domestic stability buffer. This is what we're talking about today and what OSFI is changing. This is a tool that OSFI uses to say, okay, if we hit a worst case scenario, you have to make sure you have a certain amount of cash on hand at your institution, and they can move this number up and down, and that will either increase or decrease how much money the big banks have to have on hand at all times. And this number applies to all of the assets that the banks have on hand. To oversimplify this is essentially loans that the bank has given out, right? They have assets that are mortgages, they're paying them interest, the banks are getting paid interest by the people who have mortgages, same with credit cards or lines of credit, car loans. These are all different assets that the banks have. So if the domestic stability buffer is applied to these assets, the banks either have to keep more or less on hand relative to the amount of assets they have. Just for simplicity's sake, let's say that a bank has $1 million in assets, right? These loans and things that they've given out, $1 million. And let's say OSFI has set the domestic stability buffer rate at 2%. So for that $1 million that the bank has, again, obviously an unrealistic number, but we're just using it for example, well, the bank has to keep on hand $20,000 or 2% of $1 million, right? But all you really need to understand going forward is that when this DSB goes up, that means banks have to keep more money on hand relative to their loans that they've given out. And if this number goes down, well, they don't have to keep as much money in hand in terms of actual cash that the bank has. Now, keeping that in mind, we can kind of use the DSB, the domestic stability buffer, as a way to mind read what OSFI, this big bank regulator, thinks about the Canadian economy and specifically about the big banks and how healthy they are and how much risk they think there is in the system. We can figure this out by looking at how the DSB has changed over time. Take a look at this. It tells a super interesting story because before COVID, well, the DSB was at a relatively normal level of 2.25%. All was okay, right? Then COVID happened and the banks and the regulators and the Bank of Canada and the government all were extremely worried that, oh, people are going to have to stay home. This could really result in economic scarring. This could be bad for the economy. We could go into an awful recession. So we kind of need to stimulate the economy here. The Bank of Canada did that by implementing their quantitative easing program, adding a lot more money into the system. The government of Canada implemented this by sort of providing all of this stimulus into the economy in the form of CERB payments, business loans, wage subsidies for big businesses, all these types of things, saying, hey, for the love of God, keep going out there, keep on spending, even though you've all lost your jobs for a little bit here. We don't want the economy to crash, so just keep on going out there and spending. And OSFI did the same thing with the DSB. They lowered it so that big banks didn't have to keep as much money on hand, and they were actually, as a result, able to loan out more easily to more people so that they could go spend, go buy a house, go buy a car. The banks are more likely to do that when the DSB is low. Skip forward a couple of years to April 2022, and the Bank of Canada has realized, hey, we've gone too far here. We've got a big inflation problem, and we need to slow things down by raising interest rates dramatically. Now, raising interest rates as quickly as the Bank of Canada did doesn't come without its own risks. People are sort of seeing their mortgage payments go up. All of the cost of lending has dramatically increased. Now, as a result of that, OSFI says, okay, well, maybe it's time for us to raise the DSB back up a little bit more because there's more risk that people could stop paying their loans, and we got to make sure the big banks have enough money on hand for this worst case scenario. And they raised it to the absolute maximum that the DSB could be at the time when it came time for them to make this change in June. They raised it to 2.5%, the previous maximum, which was almost immediately shattered the next time they had to raise the DSB. They made some big changes here saying, okay, we're going to remove that 2.5% cap for the DSB. We're going to make it a maximum of 4% now, and we're going to go up to 3%, the highest that it's been, higher than the previous maximum. And well, today we just learned from OSFI that, okay, it's reaching another all-time high, the domestic stability buffer, by going all the way up to 3.5%, half a percentage lower than the new maximum, but a full percentage higher than the previous maximum that was only extended in June 2022. So this dramatic rise in the percentage for the DSB kind of falls in line with the dramatic rise of interest rates, right? The more we have higher interest rates, the more risk there is in the Canadian financial system, at least in the opinion of OSFI, right? Because they're raising this DSB, they're saying, big banks, you got to keep more cash on hand in case of a worst case scenario. Now, back in December, the last time they raised the maximum DSB rate, we kind of had to guess about why they were doing it and why they thought it was important to raise it even further. But in between that last change and now, OSFI has just come out and flat said the main reason that they're concerned in a number of sort of statements that they've made and speeches that they've given. And it has to do with one bank in particular that just had a big problem leaked about it, actually just as of today, but we'll get there in a second. What I'm about to show you is all coming from Peter Rutledge, who is the head honcho at OSFI, the person who's in charge of this big regulatory body that's in charge of making sure these big banks act in a way that prevents systemic risk in the Canadian financial system. And he said a number of different risks in this sort of announcement here, but the one that they were most concerned about, first on the list, is a housing market downturn risk. They say OSFI is preparing for the possibility that the housing market will experience sustained weakness throughout 2023. We're making sure that these big banks, FRFIs, are alert to these changing market conditions. They're raising interest rates, and we're making sure that they're loaning out properly. We'll get to how that plays into a big issue in just a moment, sort of how they structure their mortgages, making sure they're not breaking any rules there. Spoiler alert. And they've also commenced public consultations on their guidelines with a focus on debt serviceability measures. Another thing we're going to get into, hint, mortgage amortizations, but I'll explain that in a second. They closed that consultation recently, and they're going to sort of update us on the changes that they made to the debt serviceability measures. All this to say, the biggest risk in their mind is, okay, what could happen if the housing market goes belly up? And to make the way that OSFI is thinking about this even more clear, the sort of second in command, the assistant superintendent of OSFI, made these statements. They said, "It won't surprise you to hear that we are not wearing rose-colored glasses. The growth in highly leveraged borrowers, highly leveraged meaning you're taking on a ton of debt, increases the risk of weaker credit performance. While lending institutions are well capitalized and financially resilient, the higher cost of borrowing and any potential economic downturn could lead to more borrower defaults, a disorderly market reaction, and even broader economic uncertainty and volatility." This is what they're worried about. Tons of people with high amounts of debt, high leverage in an economic downturn with a higher cost of borrowing, resulting in some things that could have a structural impact on Canada's big banks and the financial system in general. And there's a comment here that really hammers home a point that I've been trying to make on the channel here over and over again over the past number of months, and that's the impact of amortization extensions on the Canadian financial system. A quick update or explainer, amortizations are essentially how long you have to pay off of a mortgage, right? If you have a 25-year amortization, then the payment number that you'd be making, if you were to make that every month, would pay off the entirety of the loan, including the interest, right? But if you have a longer amortization, well, that payment number gets lower because you have a longer time to pay it off, right? Makes sense. And big banks have been using this amortization extension practice to stop people from defaulting on their mortgages as borrowing rates go up, right? If you can, if you're getting charged a higher interest rate, well, your monthly payment can stay the same as long as we stretch out how long you're going to be paying this loan off for. And it seems like, based on this statement I'm about to show you, that OSFI is kind of okay with that. This same person, second in command at OSFI, says, "We've been clear that we actually appreciate lenders working with clients to help them stay in their homes while ensuring actions taken remain within the institution's risk appetite, which we recognize can sometimes be a challenging path for the lenders to navigate." Saying, or this is essentially OSFI saying, hey, big banks, you're actually helping with our structural stability by allowing these people to not feel the full impacts of these interest rate hikes, right? But you were sort of also saying, okay, it could be risky for you to do that because when it comes time for them to renew their mortgage, well, they're not going to be able to get that chunky amortization extension out to 35, 40, 45 years. And we even saw that in the Liberal government's most recent budget that came out in April, with a section saying helping existing homeowners with the rising cost of their mortgages, saying, okay, we're actually kind of looking at these strategies that are being used, the amortization extensions, sort of payment deferrals, things like that, and we're going to try to make it even easier for people to not feel the impacts of the higher interest rates that have been a result of this sort of fight against inflation from the Bank of Canada. But now today, something interesting happened, because based on reporting in the Globe and Mail, one specific bank has been ordered by OSFI to solve a big problem that allegedly has been going on for years, and it ties into all of these mortgage problems. This is the headline from 8 hours ago. CIBC under banking regulators' remediation orders to fix mortgage underwriting lapses. To translate that, because it's a super dense title, is saying CIBC, well, OSFI has not been very happy with them, and they've been ordered to fix a big problem with their mortgage underwriting, which is essentially their process in determining that someone is actually qualified to get a mortgage. In order to get a mortgage, you have to show that you don't have a lot of debt, right? You got to show that your income can cover your debt plus some extra in order to qualify for the mortgage. Now, this is where the issue came in, because apparently there were thousands of clients, many of whom had lines of credit that were secured against their homes, and when those lines were combined with the new mortgage that CIBC gave them, well, they now had taken on more debt than was actually legally allowed based on these big banks' regulations. Now, as they should, CIBC told their clients that they had to close their other credit lines or products. You close down your credit card, close down your line of credit with us so that we can make sure you actually do qualify for this mortgage. But sometimes, as reported today, the bank performed no follow-up to ensure the clients did, even after the mortgages were issued. So we have a big bank issuing mortgages that aren't legally allowed based on the regulations that they have to adhere to. And the most damning piece of information in this article is that the bank, CIBC, still doesn't know the full extent of the issue. There could be other areas that this is happening, and has already spent tens of millions of dollars screening for problems and creating solutions, according to one of the sources that sort of leaked this, because we shouldn't actually know any of this. According to OSFI, they declined a request for comment, saying that they have a legal obligation that requires them to keep confidential any of these big issues with the banks that it oversees. So even if this were happening in other banks, or if this was happening in other areas of one bank, well, we wouldn't know about it because OSFI wouldn't tell us, and CIBC certainly wouldn't, nor would any other bank. So you can see why OSFI might have said, hey, we got to make sure these banks have more cash on hand, because we don't even know the full extent of the mortgages that they've given out and how qualified the people who hold those mortgages are to even have them, right? They better keep more cash on hand, because we could be heading towards a worst case scenario here. And in my mind, the question becomes, could this be like a canary in a coal mine? Are debt levels of mortgage holders higher than they should be at multiple big banks, or is it just CIBC? Like I said, we wouldn't know if this was happening at other banks, banks because OSFI has a legal obligation not to make these concerns public. So if issues were spreading at other banks in a similar fashion, well, we probably wouldn't know about it. But what does this increase to the DSB actually practically mean for you as an individual? Well, first off, and across the board, this would be the case, there's going to be tighter lending requirements across the board. Banks are going to be less able to give out as many loans because they need to keep more cash on hand for every loan they do give out. So tighter mortgage lending criteria in order to actually get qualified for a loan. And that's already pretty hard right now with how high interest rates are. So very, very tight lending environment is what we're living in right now. Hard to qualify for much of a mortgage at all. Hard to get a low interest rate any form of debt, right? It's going to be harder to get a loan. And then you have to wonder, what are the impacts of that difficulty to get a loan on the real estate markets, right? So far, markets over the past few months have held up decently strongly and even have showed a little bit of growth, which many people were surprised about. But some experts believe that this strength could be just a facade created by these mega long amortization extensions resulting in artificially low supply, because the people who otherwise would have been really sweating about these rate increases, well, their month-to-month cash flow is just the same because they've extended their amortizations. That results in them not needing to list their property. That results in an artificially low supply of houses on the market. When you have a low supply and the same amount of demand, well, prices are going to sort of hold up and maybe even increase like we've seen over the past couple of months. But ultimately, nobody knows for sure how the real estate market will react going forward. Like, will the Bank of Canada's most recent interest rate increase, which was kind of a little bit of a surprise, a 0.25% increase, well, will that pull things down further? Or will amortization extensions continue to sort of prop things up, being paired with more and more record immigration, sort of keeping these home and rent prices as high as they have been, maybe even going higher? We're going to have to wait and see how all of this plays out. But it seems like at the very least, OSFI is preparing for the worst and making sure the banks that it regulates are prepared for the worst too. But I'm curious what you think about all this. Do you think OSFI is making the right move by increasing this DSB? Do you think that maybe some of these big banks are to blame for more and more people getting mortgages that they might not otherwise qualify for? Or is there something that I've missed entirely here that you think is the biggest impact in all of this stuff? Let me know down in the comments below. I read every single one and try to get back to a bunch of them. And with all that said, thanks so much for watching, everybody. Subscribe to the channel if you haven't already done so. I hope this video has helped you out at least a little bit, and I'll see you next time.